We were talking about different kinds of spread, right? This is highly testable and not necessarily testable, right? Whenever you go to Bloomberg, and can you guys hear me? Okay, just give me some feedback in case there's no audio in this. Okay, okay, that's good. Yeah, this is very I would say a little bit advanced. Okay, if you're undergrad, right? However, this will make you marketable during job interviews. Most of our students will probably not go to financial institutions that will give you those kind of interview right after graduation. Okay? I wouldn't say you will never go there. A lot of them would be big, right? Pension funds, hedge funds, and some investment banking. I'm writing this using a pen. It looks like I'm writing using a mouse because my handwriting is bad. Okay. And most of our students will start from some company like financial services. Okay. I wouldn't think this is financial planning. Okay. This is we have some companies like especially in New York. Okay. Many of them are moving to Charlotte and Asheville those days. They just specialize in institutional financial product. Okay, they will also look into those fixed income. Okay, screen is hidden. Okay, that's good. Thank you for letting me know. Okay. Yeah, I'm sorry. The good thing is that we didn't cover that much. Okay, so financial services. Okay, I will talk about that. Many of you, if you are willing to move, okay, to New York, you should look at financial services companies to start. Again, many of them are moving to Charlotte too. So if you are looking around, you will probably see some financial services companies that are dealing with financial institutional investors. Okay, and then those are also the techniques they will use every day. Okay, fixed income management. Are we good? Okay, we're gonna move forward with CDS. Okay, CDS, credit default swap. I like to draw things when I'm reading, so I will just follow my habit. It is essentially insurance policy on default risk of a corporate bond, okay, or loan. And it is designed to allow lenders to buy protection against losses on large loans. And you can certainly use it to speculate on financial health of a company. What does that really mean? Okay. So first of all, we need to understand what CDS is. Okay, CDS like, let me think. If you are an investor, right? This is you. And then you buy a company. Let's say this is summertime, so many of you might be traveling, right? We have American Line here. You long their bonds, right? You long their bonds. However, you just worry. About bankruptcy. Or you can just general about credit risk. Like we talk about credit rating changes, right? That would be also considered credit risk in the previous part. So what can you do? Okay, you can also long CDS. Okay, so when you long a CDS, you essentially bought it from a different company. Maybe this is, let's say, Goldman, right? Goldman will short. They will sell you a CDS. Okay, you buy from them, right? You pay them premium. This is not very. It is very unlikely to apply to you because you are individual, right? You don't really deal directly with them, or you can just go to the market, or you can just go to the open market to buy a CDS. I have no experience of doing it, but I know CDS are traded frequently. Okay, so you should be able to get it from the secondary market. It might require you to do some additional setup with your brokerage account, like some margins, some authorization, like you have to have at least like $500,000 in your checking account to be able to do it as a accredited investor, that kind of thing. You could expect them. Okay, are we good? So what is the value of it, CDS? Okay, so let me erase all those. This is the structure of a CDS, and then we'll talk about the payoff, right? You can think about CDS as the car insurance. Okay, so this is you, right? You drive your car, and then you buy insurance, you loan insurance, right? From, let's say, State Farm, right? You can think it as the same. Okay, insurance could be considered CDS too. And then, what is the event that will pay you if you have accidents, right? And then State Farm will pay you money to fix your car. It's the same. It is the same in our setup, in CDS setup. It's just not State Farm anymore. It's just Goldman Sachs, right? Goldman will pay you money if American Airlines bond default. They will only pay you money if it defaults. Okay. Remember, this is a default event. Okay. It is a contract. Okay. They will tell you. They will have some definition of default, right? So they will say, what is the default? Like failure to pay interests, right? This will be considered a credit event or default event. And then they certainly need to decide how much money they're going to give it to you, right? Because even when American Airlines declared bankruptcy, their bonds, the value will go down, but it will not go to zero. Okay, why? Because they still have airlines. Okay, they still have airplanes. They still have some facilities. They will sell them, and then as a bondholder, you can still get some money back, right? So they will only pay the difference. It's the same for if you think about car insurance, right? If you have a car accident, the insurance company is not going to pay you 100% of the value of the car because you can always fix your car. It probably costs you, even in a bad accident, right, several $1,000s, right? You should be able to fix your car. That's how much they're gonna pay you. It's the same for this. Okay. So that's one way. That is how it is designed. Okay. However, those days we can use it to speculate, right? There are multiple ways to speculate it. First of all, you predict, right? You trade with each other, okay? Because it's an insurance, right? It's not like car insurance. For car insurance, you simply work with State Farm, you pay them premium, that's it. However, for credit default swap, you can sell this protection to others. Others can buy protection, not from Goldman Sachs, they can just buy from you or buy from anyone who has the protection, okay? Suddenly you paid some money to Goldman, right, originally. Say you paid $10 for it, and then you can always sell it for 12, right, or sell it for 14. So when will CDS be more valuable? It will be more valuable when the company on the line, when like American Airlines here, when American Airlines is in trouble, okay? So let's say you bought it at $10 because American Airlines is doing great right now. However, like a year later, they are in big trouble because people don't travel by airplanes anymore. They like to take trains, let's say, or they like to drive more, or like we have autopilot, right? We have autopilot cars. So if cars can drive themselves like for 500 miles easily, then people will probably not fly anymore in short distance, right? That will damage American Airlines, and then they might be in trouble. And then the protection you have will increase in value. Okay, so you will probably go to 12 or go to 14. Someone is going to pay more for it. That's how you make money. Okay, is that clear? That's one way you speculate. You can certainly, like we all heard about short stocks, right? So if you think American Airlines is in trouble, you can always short their stock. However, we all know that you might not short stocks, or you can just short CDS. Okay? If you think company is going to do better, you bet company will do better. Okay. So that's why you sell it, okay, or you long CDS, right? Other than short stock, some maybe you think the stock market is just a lot of noise. There are a lot of small traders. They have no idea what's going on. For CDS, it's mainly institutional traders. It's the information is delivered more efficiently. We talk about efficient market hypothesis, right? Certainly, CDS is a financial institution domain dominated market. Maybe this is more efficient, so you can launch CDS if you think the underlying, we always say underlying company will be in trouble. Okay, so that's one way. Or if you want to short their bonds, right? Let's say if you want to short a long-term bond, however, you cannot find anyone who is willing to sell it, you can always go to CDS market. You either short it or long it to reflect your opinion about the market in the future. Again, I'm showing you guys toolbox. Okay, this is toolbox. There are a lot of things here, like screwdriver, hammer. You decide which one to use. And then a lot of those are for financial institutions. For individuals, we have very limited option. However, this can give you a job, okay? Like when you do this during your job, you can use those if you are trading with a financial institution's account. Okay? You are going to get paid very well. It's very hard to get a job, okay? But I wouldn't give up. I'm trying my best, okay, to teach what I think is valuable. And even though you will never use it in the future, but if it benefits one student in the future, I think it's worth it. Okay. And then we have price, right? We can see the price of CDS. It will change and move up, right? This is very good demand. And then in 2012, we have no idea what's going on, so it also goes up. But this is only for U.S. banks, right? So maybe in 2012, the banks had some issue. It goes up too. Are we good? Okay. And then we are going to move to yield curve. Okay. I will try to finish around 20 minutes. Okay. And then we will see how much we can cover today. So yield curve is a graph of yield to maturity as a function of term to maturity. Okay. It's a relationship between yield. We have term structure. Okay. Term structure is the relationship between yield to maturity and term to maturity across bonds. Okay, so this is one example I put online in 2017. That's 2 years ago. Okay, so those are annualized rates. Okay, so I think I was teaching April 10, 2017, and then I go to the Federal Reserve. This is daily. Okay, daily Federal Reserve Treasury yield. Okay, so 1 month, okay, they are going to pay you, okay, 0.77% annualized, okay. So this is, they are not going to pay you 0.77% for a month. They are going to pay you divided by 12, okay. That's how much they pay you, okay. This is the same. Okay, 3 months, this is 0.82% divided by 4, right? It's quarterly, and then we have this. This is 0.97% divided by 2. Sorry. So this is what it says, okay? All those are annualized, okay? And then we can see that if you hold it longer, okay? If you hold it longer, okay, they are going to pay you a higher rate. Okay? That's overall. For a 30-year right here, around 3%. Okay, if you give your money to the federal government for 30 years, every year you are going to expect around 3% return. Every year. but you have to give them money for 30 years. Okay, you can sell them. I'm not saying you cannot sell them. You have to wait 30 years. If you don't like what they give you, you can always sell them in the middle. Okay? And then you can plot it. This is what it is called yield curve. Okay. This is the magical yield curve. Okay. And then the yield curve we have here is upward sloping, which means long-term rate is short-term is less than long-term rates. This is the yield curve, okay? And then it can change, right? It can shift, like you can draw a line like this, or you can draw a line like this. I'm not saying you can randomly draw. I think what I mean is the market can change. Okay, the interest rate can change. It has very, very important implications if you are managing bond portfolio, or if you are managing, or if you are in any interest rate related derivative products. Okay, and then they have a concept which is also important called forward rate. What is forward rate? Okay, so if you go back to this, okay, let me just erase all those so that we can have a clean view. Okay. So right here, okay, this is 1 year, right? You give them for a year, and then you give them for 2 years. So if you draw the timeline, okay, this is 0, 1, 2, okay. So this is 1.03% is the 1 year return. However, if you give them 2 years, right, every year combined, they're going to give you 1.25. You might be wondering, what will be the 1 year rate, right? I can get 1 year later. Why do you wondering that? You might have, like, let's say you know your dad is going to give you $1,000 a year later. And then you go to the bank, right? You know it's not here yet, okay? The point is you don't have $1,000 right now, okay? You know you're gonna get it 1 year later, okay? You will go to the bank to say, do you know the interest rate 1 year later? And then you only want to deposit for another year. That's when you graduate, you're gonna take the money out for fun, right? You will say, I'm not gonna do anything like it, it's just not interesting. However, financial institutions will. What if they have 1,000 million or $1 trillion, $1 billion? I'm sorry. What if they have $1 billion? That's a lot of money. They will need to park the money somewhere. Okay, so that's when it becomes more meaningful to them. They will go to a big financial institution to say, how much can you give me? Okay, I have $1 billion. 1 year later, I will deposit for 1 year. What is the rate you're gonna offer? Okay, is that making sense? So that's when we have the idea of forward rate. And then the financial institution will start to think, what is the rate we can give you? Okay, let me just go directly to this. Okay. So I will just go directly to the calculations. Okay. So if the 1 year rate is 8%, this is called a spot rate. Okay, this is a concept that never mentioned in the book. However, in practice, we always call it spot rate because this is a rate you can see today, okay? And then what they say is if your spot rate for 2 years is 8.995%, and then your spot rate for 1 year is 8%. What is the forward rate for 1 year later, okay? So the whole idea is fairly simple. What it says is if you invest your money, okay, into a 2 year investment, it should be equivalent to invest your money, right now 1 year investment, and then roll that over, okay? So 1 year later, you take the money out and then you roll, okay? This is called a rolling. Roll it to another investment. This is your forward, okay? A lot of time people use F11, so this way it says. Forward rate 1 year later for 1 year, okay? And then you can calculate your forward rate. This equals to 10%. Why? Because because in finance we have something called arbitrage-free valuation framework. Okay, that's just what people believe. It's a theory. Okay, I wouldn't say it's 100% true. It certainly has some limitations. It's called free valuation. What it says is, if you invest in 1 year and then roll it into another 1 year product, you will get the same return as if you invest in a 2-year products. That's how we calculate this 10%. Okay? This is our forward rate. We can see that forward rate is derived from current rate. Okay? Or more professionally, it's called a spot rate. Okay? So that's how you calculate your forward rate. Okay. So there's another example. I wouldn't go through it. And then let's focus on the yield curve theory. Okay. So this is our yield curve, right? This is time, and then this is a percentage. So why is it upward sloping? People will wonder why I will have a high return if I give my money to the federal government for a longer term. One reason would be people think it's called expectation theory. The only reason why the federal government is going to give you a higher interest rate if you hold it for a longer term is because everyone thinks, okay, everyone thinks in the future the interest rate will go up. That's why they give you a higher interest rate overall, because in the future it will be higher. Okay. Then we have some people don't agree. Some people say we have liquidity preference, right? If I give you money for a longer term, I will charge you more because I have liquidity needs. Like if you keep my money for 5 days versus 1 day, I will certainly charge you more money if you keep it for 5 days. That's what they say. They say, yes, I like your expectation theory. However, you miss one part. It's called a liquidity premium. Those are the two main theories available. We have many other series. So if you see other series that explain why the yield curve is like that, what they are trying to do is they are trying to explain the shape, okay? Explain and potentially predict the yield curve, okay? Why it matters? Because remember, when we value bond, okay, we have to have a spot rate or yield curve available so that we can discount it back. What does that really mean? Let me just illustrate what does that really mean, okay? So let's using Excel to illustrate that, okay? So this is Excel, right? We have a while ago, and then let me just pull this. This is really important, okay? If you don't really pay attention right now, okay, I will encourage you to pay attention, okay? Because this is practically what they do over there. Okay? Let me just delete everything we did a while ago. Let's just look at a 3 year. Okay, let me just do a simplified 3 year. In practice, we always do every 6 months, half year compounding. But to make it simple, okay, I will just make it for annual coupon. Okay, 1, 2, 3, 4, 5. So let's say this is a bond, right? With annual coupon of 8%. Okay, let me just do $8. Okay. Then toward the end of the day, you have 108. Okay, let's just assume the par value is $100, which is very common. Okay, 100% is what they say. Okay, in reality, it's $1,000. Let's just make it consistent. Okay, with practitioners' way of doing it. And then what is the rate? Okay, interest rate. So ideally, you are going to get the interest rate for the bond. Okay. Like if it's let's say if it's a B-rated bond, what is an interest rate for a B-rated bond? You might be able to get the yield to maturity, okay, but you probably do not really get all of those. Okay, so a lot of times we will just get a B-rated yield bond spread. Okay, let's say the spread like we saw a while ago is 10%, right? If you still remember what we've been talking about. Okay, and then you are going to apply. You will start with the Fed, okay, Fed rate. So let's look at 1 year. Okay, it's 1.02. Okay, then we have 2 year 1.24. 3 year 1.47. We don't have a 4 year, right? So we can how do we do it? In practice, a lot of times we'll just use 1.48% plus 1.88%. Okay, like year 4 is between year 3 and year 5, right? So they will just simply choose the middle point. I don't agree with it, okay, but if you have a better way to do, that's why we need to swap rate, okay, swap will give you year 4, okay. And then we have year 5, right, 1.88%, okay. So this is how you do it, and then you are going to, again, all the rates are different, okay, it's not like year to maturity, like you learned in Finance 680, the rate is the same. You are going to do a discount rate, right? Discount rate. A lot of times, discount factor. You will just use this, okay, plus your spread calculated, okay. So this is your discount rate you need to use. That's your interest rate, okay. And then you are going to do the present value of cash flow. Okay? So this will be equal to this, okay, divided by 1 plus this. Then we'll choose the time horizon. Okay. So those are all in dollars, right? And then the price you calculated will equal to this. So this is $86. Is that making sense? So this is how you calculate it, right? And then do you guys see that we highly depend, okay, our price calculation, okay, depends heavily on the federal rate. Again, this is current federal rate. A lot of times when we think about bond or fixed income, right, we need to think what will happen in the future, okay, like tomorrow, what will happen. So if you plot this is the yield curve. Okay, what will happen? It might change, okay. So as a financial analyst, right, or portfolio manager, right, you will think probably this is going to decline, okay, 1 point. So the yield curve, this will probably go up, right, 1.20. So you will probably see a twist, okay, of the yield curve. So what does that really mean, right? You guys can see the price is different, okay. And also this can go down, right? Maybe even invert it. Okay, you guys can see the price will be very different too. Right now we can see this cash flow, right? Since it's from one bond, but it can be from multiple bonds. Like year 1 you have a bond, year 2 you have another bond, year 3, year 4, year 5 you have many bonds, and then the overall value of your portfolio is also calculated this way. In reality, people will do it differently. Okay, a lot of times if this is a bond, we will probably know. Okay, we will probably know that's the price. Okay, we will probably know this already. Okay, so we are going to solve for the current spread. Okay, this is called this spread. Okay, this is where this spread comes from. Okay, because we assume the interest rate is the same. Okay, it doesn't really change. So a lot of times if you go to data, you go to solver, right? If you know the current price of this bond, let's say it's $82, okay. We're going to set, you are going to set this to $82, okay. And then you are going to change the Z spread, okay. So you can see that, currently the market thinks the spread should be 12%, okay. And then as an analyst, you will think, is this reasonable or not? Okay. If you think it's too high, the discount rate is too high, that means it's underpriced, you're gonna long it. If you think this discount rate or this spread is too low, then it is overpriced, you are going to short it. Okay, that's what people do. That's what analysts do. Okay, I hope it makes sense because this is a fundamental, okay, of fixed income. You have to understand the structure. Okay, that's why fixed income is hard, because many people get totally lost because of terminology and then the structure. Okay. This is an illustration of the yield curve series. Okay, this is the expectation series. This is the liquidity. Okay, so we just move. One essential part for this is another part. Okay, this is, let me just write it here. This is another reason why fixed income is hard, because it all comes down to what? To interest rate. Okay, interest rate prediction. And then we have many models. Okay, this is what I get from FIM curriculum. So they have a lot of different models. Most popular would be this one. Okay. The Holy model is also popular. This was tested in CFA for 2 questions, I think, in level 2. This is also tested before. Then we have CIR model. So what does that really mean? Okay, it looks like overwhelming, right? But the whole idea is fairly easy. Okay, you don't have to be an expert on those, and but it does give you some motivation to have more quantitative background. Okay, if you want to have a great future in finance, I recommend you to be more quantitative. So someone just says first, okay, the interest rate just random. Okay, it's like a random theory. Okay, it just says it is just random. Okay? Constant volatility, and also its volatility is the same. It certainly has some issues, right? So that's why it's a model. Okay, it's never choose. Okay, none of those are right. Okay, however, if you know how to do those, they are going to pay you well, and then you would just do it in your work, because we don't know a better way to do it. It's like, how do you make money? Everyone has some idea, but nobody knows to choose. Okay. Model 2, and then they say maybe it has a drift, right? Interest rate probably kind of going up or going down. It has a trend. They add a trend here. Okay. You can consider this part to be noise, and then this part is the trend. Okay. The Holy model says the trend is not constant. That's what he says. Okay, time dependent drift. So what it says is, as an analyst, you are going to, this is non-arbitrage. Okay, this trend is going to be derived from current rate. They think the market is efficient. That's why it's called a non-arbitrage. Then we have mean reversion, right? So this model, the basic model, simply incorporates something called a mean reversion. It just says when the rate is high, it will come back. When the rate is low, it will come back too. So this first part captures the mean reversion. Okay, and then we have some additional add-ons to it, right? Variation will change, that kind of, and then we have log normal distribution other than normal distribution. It looks a little overwhelming, but the reality is it's kind of fairly easy. Okay, I will just show you what it looks like. I think it's right here. Interest rate illustration. I'll go to Blackboard. Okay, I think it should be in Blackboard too. I posted a lot of things on Blackboard, so if you didn't really pay attention, you need to. Okay. If you want to really learn something out of this class, okay. I mean, I can push you, but you guys are not really kids. You guys are adults, and we have a lot of MBA students here. Okay. If you want to have a future, you need to be interested. If you want to have a future in finance, okay, take it back. You need to be interested in those. Or you can just consider this to be some kind of game that you can play for fun. Okay. So this is what it looks like. Okay. We talk about model 1. Okay, it's just random drift, right? Initial rate, let's say just 5%. Then we have this is monthly, right? Every month, what is the change? Okay, so we start with 5%, right? We have this is random, okay? This is random distribution drawn directly, okay? Because if you go to model 1 on the slide, so DW is just a random number generated from a normal distribution, okay? This is t-value. If you guys remember, t-value. This is t-value. Okay, you can just consider that to be a normal distribution with a t-value. Okay, and then this is sigma, right? This is the volatility we assume, right? The annual volatility. Okay, and then every month, okay, you simply need to change this to be monthly. Okay, and then you can just change this number. As you guys can see here, okay. So let's just plot this. So you guys see that? So this is that, right? And then how can you if you just refresh it, okay, it will change, right? If you refresh it again, it will also change. You can just do it multiple times. You guys see it? So this is this is the multiple things, right? If we just do it here, copy it. Let me just illustrate one really important concept. Okay. It's called so we tried 3 times. We are having 3 different passes. Okay. So if you just draw. So all those are future probabilities, okay? If you draw all of them together, okay? Different scenarios in the future, okay? Following this model. So in this model, we did it 3 times. Basically, it tells you in the future we can have 3 probabilities because we did only 3 times. We can have many, right? You can do 1,000 times, okay? So like 1, 2, 3, it can be like this, like that, or like this. Okay, that's when as an analyst, right, you need to come. This is what Monte Carlo simulation is. Okay, this is called a Monte Carlo simulation. Monte Carlo simulation is simulated based on a model and then just randomly draw those. Okay. By hand, I did 3 and then I feel a bit tired. Okay, using a computer, you can do it 1,000 times. We are going to shift to a different model. This is model 2. Just like what you saw before, right? Just a little bit more complicated, and then we have a drift here together with the random noise here. So you can see this is also our simulated path of the rate. Okay, and then we have the mean reversion one here. Okay, the basic model. The Excel is available online. Okay, if you are interested, certainly pay attention to it. Okay, if not, that's totally okay. It's not going to be tested. I'm not going to ask you, can you just simulate this model for me? So it will be mean reversion. Whenever it's high, it's going to go down. Whenever it is low, it will going to go up. You have to tell the model, right? Initial rate is 12%. You have to tell the model, okay, what is the theta, right? What do you think the historically long-term average is? Right here, we think the average interest rate should be 8%. However, right now we are starting at 12%, so very likely this model is going to decline to 8%. Okay, so that's what it says. Okay, again, this is only 1 time, so if you do it multiple times, you can have some really weird results. Right, we have negative rate here. That's the issue with modeling. Right, you can get negative interest rate, which is not real. Okay, I'm not saying 100% not real, but Japan has negative rate already. Okay, so that's what I have for today. I think you guys can go back and finish quiz 3, assignment 3, and assignment 4. Okay, you can just finish part of assignment 4. And also, just let me know if you have any questions. Okay. Okay, that's it for today. I will see you all next week. I think we will continue to meet online. And then after I finish chapter 11, we will probably meet in class. Okay, are we good? Okay, I hope you guys learned something. Okay, this is very useful, certainly very technical. but that's where you get paid. Okay, I can easily find a different job as a fixed income analyst, and I'm teaching you what I think is marketable skills. I also posted Python code online, like this HTML. You can see that in order to simulate this mean reversion model, this is how you do it. Okay. Okay, guys, have a great night. I might be out of town for the rest of the week. Okay. Let me know if you have any questions. Again, for exam 1, okay, if you have any questions, let me know. If you didn't do well, I will encourage you to find out issues on your side, because I tried my best to give you as many points as I can. And there are a lot of other points left in this class. So just pay attention and take it seriously, okay? I'll see you on